Dan, I guess the big question everybody wants to know is how much life is there in this rally?
I think this is just starting in terms of this next stage of the AI revolution. And I think as we go into the software phase, you see on the consumer side when it comes to AI, I believe this is still bottom of the first, top of the second inning. And that's why NVIDIA, 4 trillion, ultimately 5 trillion. Microsoft, we think on the road to 4 and then 5 trillion. It's our view, this tech bull market, get the popcorn out. I think it's going to be a very strong second half.
There's only been a lot of talk about the big structural changes that AI is bringing, not only to the companies themselves, but potentially to the economy and to the markets. You're also seeing sort of a similar sort of run for the gold going on right now in the autonomous vehicle space. And there were just some headlines a while ago out of the New York Times that Uber has actually tapped its former CEO, its co-founder, Travis Kalanick, to potentially fund a deal to buy a company called Pony AI, which makes autonomous vehicles, the U.S. arm of Pony AI, I should say, that helps to make autonomous vehicles. I do want to get your thoughts on that deal and about the amount of money and effort that these companies are spending to get ahead in this self-driving ride-hailing space.
Look, that would be the smart move for Dara, and I think there could be more behind it. Because when you look at the next phase, when it goes to physical AI, it's about autonomous. And Uber, when you look at Tesla shot across the bow, everything we saw in Austin, that's now started to play there. Uber needs to definitely focus on partnerships and expanding their repertoire when it comes to autonomous. This would be a smart strategic move, aggressive if they did it.
With a market valuation of over $3.8 trillion on Friday afternoon and a stock price that is slightly below its peak, NVIDIA is the biggest publicly traded business. The development of NVIDIA has been nothing short of remarkable. After an already incredibly amazing multi-decade history, revenue has increased by about 400% in the last 2 years due to the explosion of AI investment activity. Is it too late to invest in NVIDIA if you don't already own it? With a nearly $150 billion sales over the last 4 quarters and an estimated 95% share of its most significant end markets, it's easy to see why NVIDIA's future growth may seem limited. However, I would contend otherwise. In addition, I believe that NVIDIA's sales might increase significantly from this point on, and the company could provide returns that outperform the market for many years to come. The 4 primary business segments of NVIDIA are professional visualization, gaming, data centers, and automobiles. The most crucial part is by far the data center section. Simply put, applications with an AI focus need a massive amount of data processing power, and NVIDIA's data center accelerator devices are generally regarded as the best available. As previously stated, the company's estimated 95% market share is dominant. Additionally, the industry is expanding quickly. The $120 billion global market for data center accelerators is anticipated to nearly double over the next 5 years, and NVIDIA's data center segment sales have tripled in the last year. In only 3 years, data center capital spending, primarily by big tech companies, is predicted to increase from $500 billion to $1 trillion yearly. In other words, the biggest and most important aspect of NVIDIA's business might double or even grow in size by 2030 if it only keeps its dominant market position. There is ample opportunity for the company's other divisions to expand as well. Since advanced autonomous vehicle technology is still in its infancy, and NVIDIA currently counts 20 of the top 30 EV manufacturers as customers, the automotive sector presents a significant opportunity. By 2030, the market for GPUs for automotive applications is actually predicted to reach a value of $45 billion. NVIDIA also creates software, safety systems, and other products for the car industry. For a long time, NVIDIA's free cash flow hasn't been close to its present level, but now that the firm is making a ton of money, management is distributing it in ways that will benefit shareholders. The company does pay a quarterly dividend, but for the time being, it's a pitiful 0.03% yield. However, management is focusing more and more on buybacks. Over $14 billion, or more than half of NVIDIA's free cash flow, was spent on stock buybacks during the first quarter. It wouldn't be shocking to see buybacks increase in tandem with NVIDIA's free cash flow, which increased by 75% year over year and is predicted to continue growing quickly for the foreseeable future. Lastly, at 48 times trailing 12-month earnings and roughly 34 times sales, NVIDIA is hardly a cheap company. However, it's not always a costly one. So what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
So one of the things that's really got the street excited recently was this collaboration you guys announced with NVIDIA. Being within that partnership network, being somebody tied to NVIDIA, how important has that been for your company?
So NVIDIA has been a great partner. We've been working with them and using their hardware since the beginning. What I think is very exciting about what we just announced is if you imagine a fleet of our machines or vehicles, they're towing behind them, they're driving, they're interacting in a facility that can easily be 2-3 million square feet. How do you test it? How do you show the customer how it works? How do you train it? You can't really build these facilities for every customer, and you can't really build fleets of vehicles and drive them. It's cost prohibitive. But with the NVIDIA Isaac simulation and the Omniverse, what it allows us is to bring a virtual twin of the customer's facility online into the NVIDIA's environment, and then integrated with the Syngen self-driving technology, run everything virtually. You can drive the vehicles, you can give them missions, you can see how they interact with the material they need to handle and move things in the facility, and do it in a very scalable way. It's safer, it's cost-effective, it's more scalable, and it really gives the customer, both the customer and our team, is really the ability to experience the deployment long before the vehicles actually hit the facility.
A higher PE ratio is obviously justified by NVIDIA's revenue growth, both historical and anticipated. According to analyst projections, earnings will increase by 44% year over year in the current fiscal year, which ends in January 2026, and by an additional 34% the following year. Furthermore, NVIDIA's outstanding net margin of more than 50% and this growth rate together justify a high price-to-sales multiple. In reality, NVIDIA's stock appears to be quite appealing at the moment based on a number of widely used indicators, including the price-earnings-to-growth (PEG) ratio. The bottom line is that NVIDIA may be able to maintain growth and high returns for many years to come if a growing market opportunity, shareholder-friendly capital allocation, and a fair valuation are all combined. To remain relevant, technology companies need to change all the time. This phenomenon is nothing new to NVIDIA. The renowned chipmaker was founded in 1993 and initially gained notoriety for its visuals for video games. Before its big break in late 2022, it received a significant boost from Bitcoin mining. Currently, 89% of NVIDIA's $44.1 billion in total revenue comes from its data center business, where it sells AI chips, while less than 9% comes from its once core gaming division. However, now is not the time for management to take it easy. Its AI chip industry appears to be slowing down already. A shift to new business verticals may also be crucial to the company's performance throughout the ensuing 10 years. As hardware advances quickly and businesses eschew caution to keep up with their competitors, the beginning of a new megatrend is sometimes marked by a rush of capital expenditures. However, ultimately, margins will begin to shrink, competition will rise, and technical advancement will slow down. This happened to Cisco Systems, a networking hardware company during the dot-com boom. Even now, shares have never risen above their peak in 2000. As of right now, there is no indication that NVIDIA is about to crash like Cisco. Given its rate of growth, its value is still rather fair with a forecast price-to-earnings multiple, PE, of only 34. For comparison, the average PE ratio for the S&P 500 is 29. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Cap tech ex-Apple, we'll say, has had a very good run here. Does that continue?
I think it does. And at Deepwater, we're of the belief that ultimately that we're still in the very early stages of AI. I just want to put some quick context. I think that the mega caps are going to continue to do well. I think the real outperformance in the back half of the year is going to come from some smaller names. And if we use a benchmark, the LOUP, which is it's our Frontier Tech ETF, as a benchmark of kind of the sub $500 billion companies, just over the past 3 weeks, that's up 7%, outperforming the Mag 7, which is up 6, and the NASDAQ up 3. So Morgan, I think investors can sleep well at night owning these big companies, but also kind of think about shifting to some of these smaller cap ones that are capitalizing on what still is early stages of AI. Hard to believe, but I still think we are in the nascent phases, and I think these small companies are going to have an outsized benefit.
Early indications, meanwhile, suggest that its generative AI hardware division may be cooling off. Revenue growth for the corporation has slowed to 69% from 262% in the previous fiscal quarter. The larger story may be that its clients are increasingly using in-house solutions for their AI hardware needs, even though this may have something to do with the recent ban on chip exports to China. Fortunately, NVIDIA has a number of exciting new verticals that could contribute to income stream diversification over the next 10 years. NVIDIA will have an edge in opportunities outside generative AI thanks to its proficiency in creating and engineering state-of-the-art computer chips. Robotics and self-driving cars could be the next big thing. For instance, Tesla has already heavily utilized NVIDIA's chips in the development of its supercomputer Dojo, which facilitates the training of its self-driving taxis and humanoid robots. The latter initiative began commercial operations in Austin, Texas this month. These companies have enormous promise, even though it is uncertain how they will fare in the long run. By 2035, Goldman Sachs projects the humanoid robot market may reach $38 billion, while McKinsey analysts predict self-driving technology could bring in $300 billion to $400 billion annually. The automation and robotics division of NVIDIA has already begun to improve. First quarter sales increased 72% year over year to $567 million. In general, the secret to long-term stock market profits is long-term investing. However, some unanticipated concerns may surface when your time horizon extends from years to decades. Ernst & Young claims that due to technological disruption and a failure to adjust to changing circumstances, the average U.S. S&P 500 company only lasts 15 years. Even if they survive, many others go through protracted spells of stagnation. NVIDIA's extensive reach and competitive advantage in cutting-edge computer hardware design allow it to hold a commanding lead. It is likely that these industries will continue to exist for some time to come. However, as the generative AI market matures and may slow down, its management's ability to make long-term pivots to other technological verticals will determine if it survives. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.